Welcome to the TAC Index AI podcast, November 27, 2025, where we blend TAC IP data, reports, and charts with the latest news in all things logistics with a focus on air cargo.
Great to be here.
So today we're doing a deep dive into the air cargo market. We're seeing the U.S. holiday peak begin to ease up a bit.
Right.
But there's this really interesting disconnect happening between the easing rates and some pretty dramatic supply shocks that are hitting the system.
It's a fascinating paradox right now. It really is. If you look at the latest data, the global air freight rates, that's the BAI 100 global index, they've actually eased slightly.
Okay, so a small dip.
Yeah, it dipped about 1.5% week over week. It basically just confirms that seasonal pattern we always see.
Right.
The first big rush of peak season is over.
But here's the kicker, and this is the central issue, I think, for logistics managers right now. Despite that little bit of softening, the overall market is still extremely tight.
Okay.
I mean, the global index is still up, just narrowly, but it's up 0.3% year over year. And that tightness is about to be tested by a huge, unavoidable capacity problem.
Exactly. We have to talk about the grounding of the MD-11 freighter fleet.
The big one.
Yeah, following that recent fatal crash,
Yeah.
This is not just a hiccup. This is a structural blow to global air freight capacity.
It's a workhorse, that plane.
It's a crucial long-haul workhorse. It's specialized for these massive, high-volume transcontinental routes. So when you just instantly pull that entire segment of supply out of the sky,
It doesn't matter if rates dip for a week.
it doesn't matter. The underlying capacity is just fundamentally constrained for the foreseeable future.
That context makes all the regional data so much more interesting. Let's look at Asia. Outbound Hong Kong, the BAI 30 index slipped 1.4% week over week.
And Shanghai, which is the BAI 80, also dipped a little bit, just 0.2%.
But you have to look past that weekly number, right?
You have to look at the long game. Shanghai is still way ahead year over year. It's up 6.6%. That tells you the sustained flow of goods is still very robust.
And then you have the surprises.
Right, the exceptions. We saw rates jump significantly week over week from Taiwan and Seoul, and specifically on the lanes heading to the U.S.
So that tells you that, certain specialized goods or maybe urgent holiday top-ups are still commanding those premium prices.
Exactly. Now, if we look west, we see that cooling trend a little more dramatically.
Right. Rates fell from those key European and U.S. hubs. Frankfurt was down 3.3%.
And Chicago took a pretty steep fall, down 6.1% week over week.
Meanwhile, London Heathrow, that's the BAI 40, it still has a comfortable year-over-year lead, up almost 8%, even with a tiny weekly dip.
So it suggests that Europe to U.S. demand is stabilizing, but that Asia to U.S. urgency is still paramount, and that goes right back to the supply constraints we just talked about.
Okay, so let's pivot from the physical constraints to the external factors, the costs.
We have to talk about fuel. Oil futures settled higher last week. WTI and Brent both climbed about 1%.
And if we connect this to the bigger picture, it's all tangled up in geopolitics, isn't it?
It is. The price uncertainty really comes from this ongoing focus on the Russia-Ukraine peace negotiations.
That's right. I mean, if a deal happens, that could eventually lead to lifting sanctions on Russian crude.
Which would increase supply and hopefully lower jet fuel costs in the future. But the market is reacting to the possibility of that right now.
Which raises the other big question, what about the demand side? The thing that actually fuels the air freight business.
Well, there is a lot of optimism in the financial markets, and it's being driven by the high probability, I think it's around 85% now, of a December Fed rate cut.
And that's a massive positive signal for logistics. The S&P 1500 Airlines Index, it jumped 3.0% last week.
That's a huge barometer. Air traffic is always seen as this key indicator of consumer health, especially heading into that final holiday push.
And you've also got some stability from the U.S. extending those tariff exclusions for some Chinese imports.
That's right, for about 178 product categories. It just helps maintain predictable trade flows for another year.
Okay, so let's tie this all together. What does this all really mean for someone listening?
Well, you're seeing a market that has hit a slight seasonal pause, but, and this is a big but, it's sitting on top of a ticking time bomb of capacity scarcity.
The MD-11 grounding.
That's the one. So the rates may have softened for a moment, but the cost foundation is volatile because of fuel, and you've got these increasingly strong consumer demand signals. The pressure is shifting from just rates to actually securing guaranteed space.
So the major takeaway is that while the data suggests a bit of a cool down, the system itself is structurally stressed. Any unexpected surge in demand is going to send prices rocketing straight back up.
Until next time.